Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, July 7th, 2021, and I'm pre-recording this Trading Places Live for Thursday, July 8th. Futures currently are down a little bit, not a whole lot. Dow futures down 57, S&P 500 futures down 6, NASDAQ futures down 6 3/4. So it does look like, at least at this point, as though we might get off to a slightly negative start on Thursday, but things change overnight. So we'll have to wait and see how things open on Thursday morning. But at least for now, it does look like things are just a little bit weak here in the after hours session. Let's walk through the agenda for this Thursday. So we'll start off with the daily market recap, go into talking technically. Then take a look at candlesticks. I'm going to go over a few different kinds of candlesticks. Candlesticks are something I use very frequently, talk about a lot on the shows and with our members at Earnings Beat. So I thought maybe we would just talk a little bit about a couple of different types of candlesticks that I like to follow. Mostly reversing candlesticks. That's what I like to use as a short-term trader. Then we'll get into earnings spotlight. I've talked about a lot of upcoming earnings in recent shows. And I thought maybe I'd go through some companies that are going to be reporting here over the next week to week and a half that I haven't talked about yet and how they look going into earnings. So that'll be in earnings spotlight. Then we'll wrap up with the three you must see. But before we get into any of that, let me take you over to earningsbeats.com. If you are new and you go over to earningsbeats.com, you'll see this area where you can sign up for our free Earnings Beats Digest newsletter. This is a newsletter that's published 3 times a week, Mondays, Wednesdays, and Fridays before the market opens. Generally, it's focused on earnings and relative strength and sometimes even candlesticks. I mean, things that just help to educate and hopefully illustrate the way we approach the market at earningsbeats.com. All you have to do to get this newsletter is put in your name, email address, hit that subscribe button. We'd love to have you join our community. Like I said, it's free, no credit card required. You can unsubscribe at any time. So definitely check that out and make sure you're taking advantage. We also do free events from time to time, and we reach out to our Earnings Beats Digest community in order to send out room instructions and things of that nature. All right, moving on to the action on Wednesday. So this was kind of a strange day for me. I don't know if it was for those of you out there listening, but I was doing a lot of trading and have been recently more of the growth stocks. And growth got off to a really good start. And, you know, for the most part, I mean, you can see the NASDAQ finished with a very slight gain that set a new record high, although barely. The NASDAQ was overtaken by the Dow and the S&P, but it seemed like a lot of the growth stocks were selling off. Many of the software, semiconductors, you know, areas like that, renewable energy, autos, some of the areas that had been performing pretty well of late struggled on Wednesday. And it was kind of odd because Treasury yields were down quite a bit, and many of these growth stocks got off to good starts and just simply couldn't sustain it. Saw a lot of stocks selling off throughout the day. So it's just one more example, I think, of the crazy rotation that's been taking place. Now, this was a little bit more of a, you know, on a one-day scale, but we've seen this kind of crazy rotation back and forth going back over weeks and months. And so this was just, like I said, maybe on a little smaller scale, but still somewhat perplexing, I would say. Anyhow, the Dow Jones did finish with a 104-point gain. S&P 500 was up a little more than 14.5 points. The NASDAQ, as I mentioned, did finish up 1, set a new record, but underperformed on a relative basis. Mid caps eked out a tiny gain. Small caps lost again. You know, we really have been struggling with energy of late, and there are many small energy companies. And so when energy struggles, many times we'll see small caps underperform, and that was certainly the case on Wednesday. In terms of strength, looking at sectors, Materials and industrials, the two best performing industry groups, both gaining 1% or more. Materials was interesting because the dollar was up throughout the day, and materials nonetheless was the best performing sector. Now, we didn't get back through the 20-day moving average, and so that could have just been a little bit of a quick little bounce before another move to the downside. But hey, up is up, and materials and industrials both showing gains on Wednesday. Energy, very weak. Crude oil prices, after going up and hitting $77 a barrel, or almost $77 a barrel. I think we hit 76.98 a few days ago, or a couple of days ago. We actually reversed off of that, and crude oil prices have come down quite a bit, and that's put some pressure on energy names. I would be watching maybe these lows that we've seen here over the past 2.5 months in the 51, 52 area. We closed on Wednesday on the XLE at 52.05. So got some work to do here. The bulls have some work to do to get back up and break above the recent high, the June high, around $56. Steel, part of that materials group, had a very strong day, but like materials, couldn't get through the 20-day moving average. So it was a nice day, but it came after a down day. So it got back some of those losses, but still unable to pierce through the 20-day moving average. It looks like we're downtrending. So as long as we stay below that 20-day EMA, I would treat this as a downtrend. Travel and tourism, rough day on Wednesday, down more than 3%, 26 points, and actually closed the lowest level we've seen in about 6 weeks on the travel and tourism group. Seems like we're likely heading to test the low that we saw back in May below the 800 level. We'll see whether or not we get down that low, but the action on Wednesday really not very good. All right, the 10-year Treasury yield, taking a look at this chart. And this is what was somewhat perplexing to me, because we see the yield down 5 basis points, 1.32%. We know low interest rates help to fuel growth stocks. And for the most part, we were down all day. I mean, I'll take a look at this 10-minute, 5-day chart, and you can see we went down and then for the most part just went sideways the rest of the day. Didn't see the yield go any lower, but really didn't see a whole lot of movement back to the upside either. So we're in this confirmed downtrend here in the short term. And if we go back and we look at this year-long chart, I think we've been in a significant downtrend really since the beginning of April, late March, beginning of April. And in particular, since about the 3rd week of May, the end of that 3rd week. So I'm going to say the last 6 weeks or so, we have been pretty steadily downtrending on that Treasury yield. That's been putting some relative pressure on financials and industrials. Financials underperformed again on Wednesday. Industrials, as I mentioned at the top of the show, actually did bounce back a little bit, but it could have just been a little bit of a rebound before we see further weakness kick in. All right. As far as economic reports on Thursday, initial jobless claims will be out at 8:30. So by the time you're listening to this, you can check on that. The estimate is for 353,000. Last week was 364,000. So we're expecting that to drop a little bit. That would be good economic news, which you would think might lead to a little bit of a bounce in the yields back to the upside. We'll have to wait to see how that unfolds. Let's go ahead and move on. I want to talk a little bit more about this 10-year Treasury yield, though. And this was a chart that I showed to folks that came to our 2021 second half market outlook webinar that we had the night before last. Well, by the time you get this, it'll be night before last. We actually had it on Tuesday evening. And this is kind of a basic theme. I mean, if you want to understand a little bit more about the market, maybe you already understand this. If not, hopefully this will, give you some more insight into the market and how it operates. When yields are rising, Treasury prices are going down. And when yields are falling, it means Treasury prices are going up. There's always a 100% inverse correlation between the direction of Treasury prices and the direction of Treasury yields. All right, so anytime you see the yield, and that's what this top part here is, the 10-year Treasury yield over the last 10 years. So anytime the yield's going down, it means folks are buying treasuries. They're a little bit more defensive. And when the yield's going up, it means folks are selling treasuries, maybe getting a little bit more aggressive, moving into equities. Well, that's kind of what this chart tells us. And what I did is I went back and I looked at periods when the 10-year treasury yield rose and periods when the 10-year treasury yields dropped and then rose again, then dropped and then rose. And I want you to look at what happens to the S&P 500 during these periods. So we were pretty flat back at the end of 2011, first half 2012, while the yields were falling. When the yield turned around and started moving back up for about a year and a half, the S&P 500, which is the chart down here, the S&P 500 rose more than 43% during that year and a half, or roughly year and a half. Then over the next 2 3/4 years, for the most part, I mean, we had a little bit of movement to the upside here in the treasury yield, but for the most part, we were trending lower in the yield during that year and 3/4. And if you look at the S&P 500, we went up, but only slightly during that period. And then we had a nice period to the upside where the yields were rising. S&P 500 during this period rose 36.7%. Then we had the huge decline in treasury yields, a lot of choppiness in the S&P 500, and we ended up over this period of about a year and 3/4. We finished up a little bit from where we started. And then since midsummer 2020, we've seen the yield rising. We went from about 0.4, 0.5%, and we rose up to 1.7%. We've pulled back a little bit lately, but I still think the overall uptrend is in play at this point on the 10-year treasury yield. And you can see since that's occurred, we've had the S&P 500 go up about 32%. And that's in, just about a year or so. So I think it's pretty clear if you look at this chart that when the treasury yields are trending higher, it tends to be a good thing for stocks. And, for me, this is common sense, because if you think about it, when yields are going up means folks are getting out of treasuries. Why do they get out of treasuries? Well, normally you would get out of treasuries when you're seeing the economy improve or when you're expecting the economy to improve. And the reason being that when the economy begins to improve, the Fed has a much higher chance of raising interest rates. And if rates start to go up and you're holding a bond, the value of that bond starts to go down. So you lose money by holding a bond. Now, on the flip side, if you get out of your bonds and sell and move into stocks, stocks tend to do very well when the economy's accelerating or strengthening, because companies do more business. And in theory, they should book more profits. And then PE ratios go up and they expand. And so you make more money in the stock market. So that's the normal relationship. Now, when I say normal relationship, and when you're looking at this chart, these are really secular bull market rules. If you're looking at a secular bear market, normally when you see yields dropping like this and money rotating into treasuries, it's usually at the expense of the stock market. Stock market, you're seeing a lot of people selling, a lot of people moving the sidelines. Folks tend to put more money in money markets. And as a result, in a secular bear market, when yields drop, usually the stock market gets hammered to the downside. And when yields rise during a secular bear market, we usually see the S&P 500 move up, but not like we do during a secular bull market. So that's, if you go back and you study history, that's kind of what you'll see. So I just wanted to point out that right now we're in one of these periods in a secular bull market where yields have been rising. And as a result, we're seeing the S&P 500 move up for the most part unabated, just continuing to move higher and higher. So just wanted to point that out, make sure that you're aware of this, because to me, this is intermarket analysis 101. The rotation between asset classes. So you got stock market, you got the bond market. When money is coming out of the bond market, it usually fuels a stock market rise. And when money comes out of the stock market, goes into the bond market, that tends to squash stocks a little bit. Now, you might ask, well, why, when the yield is going down, why don't stocks go down? Because that means money's going into bonds. So why wouldn't money come out of the stock market to fuel the bonds? Well, it does. You do see that rotation, but you also have new money coming into the market. So the new money helps to fuel the S&P 500 and keep it relatively flat with choppiness. All right. The final thing I want to point out on this chart is just the correlation. So if you don't believe me and you don't believe these two panels here that you're looking at and how the correlation seems to be going together, then you can look at the correlation coefficient itself. This is the correlation coefficient of the 10-year Treasury yield and the S&P 500 over a 20, well, this is a weekly period, so this would be over a 20-week period. And anytime you have correlation above zero, it's positive, below zero is negative. If you get above 0.5, you're starting to talk about strong correlation, positive correlation. Moves below negative 0.5 would be very weak correlation or inverse or negative correlation. And as you see, looking at this, when you look at the correlation between the 10-year Treasury yield and the S&P 500, we get up into the 0.5 or above area quite often, and we have over the last 10 years. Rarely do we get into the minus 0.5 inverse correlation area, this red shaded area. So just another way to point out that there is pretty strong positive correlation between the direction of the 10-year Treasury yield and the direction of the S&P 500. Not over long periods of time. We're talking about short-term rotation, okay? Because you might look at this and say, well, you know, the 10-year Treasury yield went down over the 10 years. How can the stock market go up based on the theory I'm giving you? Well, again, it's not a 10-year cycle. We're talking about short-term periods where money is rotating back and forth. Over long periods of time, you got a lot of new money coming in the market. So it's not just rotation. But in the short term, the rotation can really fuel things. All right, let's move on. I want to talk a little bit about candlesticks. So the first candlestick I'll talk about is a bullish engulfing candlestick. Now, a bullish engulfing candlestick is a candlestick where the body of the current candlestick that you're looking at completely engulfs the prior candle body. So I'm going to shorten this a little bit. We'll just look at 3 months. So the one thing you have to understand about candlesticks is when you have a filled candle body, like the red, solid red rectangle, what triggers that is a close below the open. So if you're closing below the open, the close is down here at the bottom of this rectangle, and the open is at the top of the rectangle. So you closed below it. So it's kind of a bearish implication. And as a result, I always think of red and bearish. So I always think of red filled candle being bearish. Okay. Now the hollow candle, where it's not filled, but it's hollow, that's the opposite. It's where you're actually closing at the top of the rectangle and opening at the bottom. So in the case of NAPA, the Duckhorn portfolio, we had been moving lower for a while. Now, if you want a reversing candle, the first thing you need to do is establish a downtrend. Well, I think there's obviously a downtrend that was in play here with NAPA. And then we put in a bullish engulfing candle where we gapped down at the open below yesterday's close. And then we traded up most of the day and completely engulfed the prior day's candle body or a rectangle. The other thing I liked here was the fact that the volume picked up. So not only did we get a reversal and an engulfing candle, but we also saw volume pick up. So what this would tell me is short term, I'd be looking for a move to the upside. Not that I'm looking for it to go up to 30 from 21 and change. It could simply be one day. Sometimes these candlesticks, these reversing candlesticks last for a day. Sometimes it's 3 days. Sometimes it marks a major bottom. And then sometimes it just doesn't work. And we'll see the stock go down and never print another new high. Nothing's a guarantee. So usually when I'm looking at reversing candles, I'm trying to find corroborating evidence that would suggest that it's ready to reverse. So for instance, if this had been just a little lower, see how we had this big volume move up, breaking the prior resistance at about 19.5? Well, if we had gone down to about 19.5 and had reversed with that bullish engulfing candle, I would have felt much more bullish about it. But the fact that we haven't gone down and retested that prior breakout level tells me potentially we still have 19.5 to go. We may have to still go down and test that 19.5 area. So just something to keep in mind. But I do like these reversing candles. All right, so that's one. The next one I'll show you is Enphase, ENPH. So in the renewable energy space. So you just saw a bullish engulfing candle. Let me show you a bearish engulfing candle. It's the opposite. So here you can see we had a pretty steady uptrend, even though we went sideways for a few days. But for the most part, coming off of this uptrend, intraday, we went up and had a new high. It looks like we were breaking out on Enphase. And then by the close, we had come down, printed this red filled candle, completely engulfing the prior day's candle body. That is a bearish engulfing candle. And normally when I see that, I'm looking for some additional short-term weakness. Don't be surprised to see Enphase go down and test its 20-day moving average. That would be down around 170, another, 6% or so from current price. So that's what I would be looking for based on that candlestick. The next one I'll show you is SMAR. This is a dark cloud cover candle. Now, if you look at it, it looks a little bit like the bearish engulfing candle. If I go back and show you that one again, big red filled candle completely engulfs the prior candle. Well, the dark cloud cover is very similar, except it just doesn't quite make it all the way down for a complete engulfing. So a dark cloud cover is where you gap up off of an uptrend, and then you come back down, you close in the bottom half of that prior day's candle body. So it's a wannabe bearish engulfing candle. It never quite made it. So for me, bearish engulfing candles are a little bit more bearish than these because these do not completely engulf the prior day. But still, you can see volume picked up. We were in breakout territory. And one thing that maybe bothers me a little bit more with this one is that as we're trying to make this breakout, and as we did make this breakout, we did it with a slight negative divergence on the PPO, and then we had this reversing candle to boot. So I think that is maybe a double negative going into Thursday. We'll see what happens with Smart Sheet, but I'd be looking for at least to pull back to about the 72 level. And if it doesn't hold its 20-day with that negative divergence, we could easily see a 50-day test. So that would be pretty scary from 78 down to about 63. That would be about a 20% correction on the stock. I'm not saying it's going down there. I'm just saying I've seen this happen plenty of times with a negative divergence and a reversing candlestick. Last one I'll show you is a hammer. So with Savara, SVRA, we moved down, down, down. The hammer, it's kind of looked like a hammer. You got this long handle, and then just kind of picture the head of a hammer here instead of the candle body. Or maybe like a sledgehammer. Kind of looks like a sledgehammer. But the thing I like here, notice that we got this reversal right at this prior support level. So I would look for at least a short-term move back to the upside on SVRA. All right, let's move on to earnings spotlight. So I'm going to go through some earnings or some companies that are going to be reporting earnings. I'm just going to go through a handful of them pretty quickly. SLP been trending lower. Look at the relative weakness. It's horrible. Software has been doing very well lately. And here's a software stock that has not, down near a 52-week low. Something about it Wall Street doesn't like. And if Wall Street doesn't like it, I'm not going to like it. Pepsi. Good news and bad news here. Good news, we're breaking out, starting to show some really nice relative strength versus soft drink peers. The bad news, soft drinks have been horrendous versus the S&P 500. So it's a really bad group, but Pepsi is kind of, strengthening a little bit, even though it's in a weak group. I don't know. I tend to stay away from stocks like this. I prefer leading stocks in leading groups, not leading stocks in lagging groups. Fastenal, FAST, nice move up on Wednesday. Still got a little work to do to break out above the May high. We are seeing relative strength pick up. I don't know. This one, volume trends have gotten a little bit better. AD line just broke out. I see some good things here, but we've got to clear 54.5 first. Conagra, CAG. Look at the relative strength versus food products. Just very, very weak stock in a very, very weak group. Not interested. Staying away. BlackRock, BLK. So this is in the asset managing group. And you can see relative to its peers, it's at about a 5-month high. Breaking out again on Wednesday to another new high. AD line breaking out. I think BlackRock looks pretty good. I'd expect a good report here. Maybe one or two more real quick. DAL, this is Delta Airlines. All right, Delta got some support here at about 42.5, 43, and it actually closed below. AD lines rolling over. Volume trends have turned negative. We're failing to get through the 20-day, so it looks like we're trending lower. But over the last month, even though it's been trending lower, it's actually outperforming its peers because its peers have been going down even faster. So, yeah, it's doing better than its peers, but it's still downtrending. And it just closed at about a 5-month low. AD lines rolling over. Not really liking this one going into earnings. And the last one I'll point out here is United Health. United Health, I actually think looks pretty good. I see an uptrend. I see maybe a cup that's been forming. And on a relative basis, we're at about an 8-month relative high, UNH versus healthcare providers. So I think this one looks pretty good. All right, let's wrap it up with the three you must see. I'm going to start off with NEO in the auto group. NEO, even though it had pulled back quite a bit in the spring, you can see the AD lines remained very strong. And now the stock started to come back up. It pulled back. I wanted it to hold its 20-day moving average, and it closed just below it. So I'd like to see it come back up and get back up above its 20 on Thursday. If not, then I'd be looking more down toward the 40, 42 area. Next up, VISL. This is Vislink Technologies. Look at that false breakout there above these highs. You see this false breakout with the black candle there? Couldn't get above, well, got above intraday and then failed. Look what happened the next few days. Once again, we fail. Look what happens the next day. This is just an educational point. You want to be careful when your stocks have false breakouts. Last thing I'll point out, Charter Communications recently breaking out all-time high. I think this stock looks good. AD line moving to about a 5-month high. I expect that this stock's going to continue to trend higher over time. All right, that's it for me. Appreciate everybody tuning in. Next show, Next Trading Places Live will be Monday over at Earnings Beats. That will start at 9 a.m. Eastern. Everybody have a great Thursday. Rest your week. Enjoy your weekend. I'll see you next week. Take care, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.